Today, we're looking at a pretty bold contrarian call on NIO Inc., arguing that at its current 5-year low, it's a strong buy for 2026 thanks to record deliveries and new brands. So let's jump right in. The analysis has a very clear hook, which is this high-risk, high-reward frame. It's really hammering that 80% upside to a $9 price target. It definitely grabs your attention.
It does. It's a compelling story. But for that framing to really work, the high-risk part needs to feel just as well analyzed as the high-reward. And right now, it doesn't. So the discussion of this high-risk, high-reward play really needs deeper context on the downside. It has to align the severity of this massive stock drop with the pretty thin support level that's being presented.
Yeah, as I was reading it, I saw the analysis puts the downside support around 450, which is what? A 64-cent buffer from the current price. That feels, it feels like a line on a chart, not a real floor.
Precisely. And that's the weakness right there. The focus is so heavy on the potential upside that it almost minimizes the risk by just offering this brief, chart-based mention of support at 450. I mean, that small buffer just seems totally insufficient, especially when you remember this stock was trading below $3 not that long ago. It's faced, almost existential negativity for 5 years. The actual bear case, the very thing that drove the stock down, is barely even addressed. It makes that 450 floor feel arbitrary.
Right. If the stock has shown it can drop 40% below that supposed support level in the past, you can't just rely on a technical line. The analysis has to prove why the fundamentals are different now. Anyone reading this needs to feel confident that those historical pressures are actually gone.
Exactly. So the suggestion here is to strengthen that high-risk part of the thesis. You have to engage directly with the strongest bear arguments, the ones that got the stock down to $3 in the first place. Then you show how the new catalysts, like the record December deliveries or that $2.7 billion in cash, specifically fix those prior fears. You shift the whole argument from a technical one to one about fundamental solvency.
Okay, so this is where we stop treating the downside as just this small possibility and start treating the risk mitigation as a core part of the whole contrarian argument. You have to make the floor feel structural.
Yes, and for a concrete example, instead of just saying 450 is the support, you frame it as a structural floor. Quantify the assets. Use that $2.7 billion in cash against the current cash burn rate. Show exactly how many quarters that cash gives them, even if sales just completely stall. That builds a true financial floor that's just way more believable than some line on a chart.
That's a huge adjustment because you're redefining the risk. It's not how far could it fall anymore. It's how long is the company guaranteed to survive. But you have to address the old weaknesses too, not just the cash.
Oh, absolutely. And you can make those mitigations really targeted. The piece highlights that jump in QK vehicle margins to 14.7%. So what you could do is you could briefly introduce a major historical concern, like, say, the huge operational costs of the battery swapping network, and then immediately show how that 14.7% margin specifically resolves or, dramatically improves that exact problem.
Because battery swapping has always been the thing skeptics point to, right? A constant cash drain instead of a revenue driver. So showing margin improvement in spite of that structure is really powerful. It's solid, measurable proof that the old risk factors, that high cost of doing business, are fundamentally changing because of scale and efficiency. That turns a historical liability into a current asset. It makes the whole thesis so much stronger.
It changes the whole psychology for an investor. That 450 level is no longer just some line. It's backed by actual financial modeling.
Yeah, that kind of structural assurance is a total game changer. Okay, so let's move to the second pillar of this whole story, which is the new product cycle. Let's look at this January 2026 launch of the Firefly sub-brand. The analysis calls it a game changer.
And it's definitely a strong hook. You've got Firefly, the mid-market Envo, and the premium NIO brand. It's a full-spectrum attack on the EV market, which sounds really exciting. However, to really justify that game-changer label, the analysis has to address the execution risk and, maybe more importantly, the potential for cannibalization that comes with launching a new mass-market sub-brand.
Right. The analysis sort of treats the launch of Firefly, which it calls NIO's Model 3 moment for younger buyers in Europe, as this purely positive thing, almost like it's a guaranteed new revenue stream.
And that's the weakness. That view just overlooks the huge challenges of launching a new, totally unproven brand. I mean, you've got massive execution risk, new supply chains to manage, and the very real risk of diluting or cannibalizing your existing higher margin premium cars. Launching a new brand is not easy, and the analysis needs to face that risk head on.
So, building on that, the suggestion is to bolster the argument with some kind of structural assurance about brand separation, or maybe project some specific market positioning. We need to see clearly that Firefly is going to expand the market, get new customers, not just pull existing ones away from the higher margin NIO or the Onvo brands.
It's a classic brand management problem, right? If the three brands start to overlap on price or who they're targeting, the success of Firefly could actually end up crushing the company's overall margins. But then again, isn't some internal competition just inevitable when you go from a niche player to a mass market one?
Maybe, but the analysis needs to show that the company is trying to separate them structurally. It has to prove that NIO has done the work to minimize that risk. For example, and this is a concrete thing you can add, the analysis should detail the structural separation strategies. Are they using totally separate manufacturing plants, different showrooms, marketing that's aimed only at people who would never touch a core NIO or Onvo car?
That kind of operational detail would show the writer has really thought through the complexities of brand architecture and supply chains. It turns what could be just a press release into a properly vetted operational plan.
And since Firefly is supposed to be this high-volume, lower-cost product, the margin impact is everything. So the writer could add a brief directional projection. Estimate the minimum monthly delivery volume Firefly needs to hit just to contribute positively to that overall 14.7% vehicle margin target.
Exactly. That shows the operational threshold for success. It transforms the catalyst from just a hopeful announcement into a quantified challenge that the writer is confident they can overcome. It shows you're focused on profitability per unit, not just the headline delivery numbers. If Firefly needs 20,000 deliveries a month to break even, that's a very different story than if it only needs 5,000. Quantifying that is, well, it's key.
It's the difference between optimism and actual due diligence, for sure. And that ties perfectly into the third and maybe the most crucial part of this whole contrarian thesis, the path to profitability. The analysis makes a really strong case that NIO is about to get re-rated upwards because of its performance and scale, which is the whole justification for the strong buy.
Right. That assertion is critical. And it's built on two very strong pillars, that jump in Q3 margins to 14.7% and the record December delivery number, 48,135 vehicles. But then, right after laying that out, the analysis just ends the discussion by citing analyst projections from Morgan Stanley and Goldman Sachs.
And that's the weakness we have to fix. Relying on that external consensus just weakens the analysis's own claim that the re-rating will be violent and all upside. It doesn't articulate the how, the operational mechanics of actually getting to break even using the company's own data. It feels like the writer did all this great work finding the catalysts and then just outsourced the final conclusion to Wall Street.
Yeah, you want the analysis to feel proprietary, driven by a deep understanding of the company's economics. The assertion that NIO is on the path to profitability needs a much more detailed, internally focused breakdown of how these volume increases translate directly into operating leverage, instead of just leaning on external validation.
So the suggestion for improvement is to shift the focus. Move away from who is making the projection to the quantifiable mechanics of the turnaround. You need to integrate those record delivery numbers with the company's fixed cost structure to build a credible internal path to profitability.
That operational threshold is the real hinge for the entire investment case. To make this actionable, use that record 48,135 delivery number as your foundation. The writer should try to estimate the company's current monthly break-even delivery volume, that key operational threshold, and then explicitly state how close that recent record gets them to hitting that number consistently.
Hitting break-even is so often less about analyst opinions and more about hitting that critical volume. It's a verifiable internal target. That volume target then becomes the new key metric for the reader to track. It shifts the focus away from quarterly losses to this impending inflection point. And that's way more convincing than just a price target.
And to back up the idea that the margin expansion is real, the analysis should explain why that 14.7% margin is sustainable. Is it because of cheaper components, long-term supplier deals, better manufacturing scaling? We need to know this wasn't just like a temporary holiday sales bump.
And if the analysis can show that the 14.7% is structurally sound, then the new mass market brands are designed to improve this margin through scale, not dilute it. If the writer can demonstrate that level of modeling and show that the operational break-even point is just around the corner, the argument becomes fundamentally sound. It gives the reader a clear roadmap to follow.
It transforms the analysis from just market observation into an executable, quantified strategy. If they actually hit that break-even number, the violent re-rating they're predicting becomes